Hello, my name is Steve Jablonski, and I'm hosting Financially Speaking with Jeff Bush. We are actually doing a investment 102 today because we started on our last show and got about halfway through, so we'll do a little bit of review for those of you that had seen it, and if this is the first time seeing this show, then it'll be new for you. And with that said,
Yeah.
Jeff, here we go.
Might be a good idea to go back and watch the original show in the archives of PCTV. But Steve, welcome to the show. It's great to be here on the PCTV network as we do Financially Speaking, like we do every month. We're here today high atop the Security Trust building in our office on 152 East High Street in Pottstown. And Steve, we've been doing this show now for 12 years. It's hard to believe, and we've covered a lot of topics, but we never really dug deep into the investment aspect of it, like we started to do the last show, where we really started with the basics, talking about, bank accounts, money markets, checking accounts, savings accounts, and that kind of thing. And then we progressed into the more advanced types of investment instruments like stocks and bonds and mutual funds. So we want to continue with that discussion today because I think it was a valuable lesson, a valuable show, and we've got really good feedback on it. So let's continue.
Yeah. So to begin with, why don't we do a little bit of a review on stocks, bonds, and mutual funds, and then we'll get into the rest of the
So stock, what is a stock? A stock is, you own a piece of a company, right? So you have a company that maybe is a public traded company, and they issue different types of stock. It could be preferred stock or common stock. But most of what consumers are used to seeing is the common stock, right? So what happens with common stock is you're taking risk. You're taking stock market risk. So when you own a stock, you own a piece of the company. You're actually one of the owners of the company. So if you have 100 shares of IBM, you actually own part of IBM. You can vote. You can go to the shareholders meeting and vote, or you can vote by proxy, meaning you could vote by mail. And the stock is going to go up and down based on market conditions, and there's risk involved there.
And when we hear large cap, mid cap, small cap, what does that mean?
It means the size of the company. So large cap, it's abbreviation for capitalization. Yep. So when you hear the term large cap, you're talking about the big stocks, the big boys, IBM and GE and AT&T and the big companies. And then the mid cap are the next level down. They still are issuing stock, but they don't have I forget what the delineating the demarcation is of what's the difference between.
I know it's price times float.
Yeah,
but I'm not sure.
So it has to do with shares outstanding.
Yep.
But mid cap it's just a different market where they're smaller than. I'm stating the obvious, but they're smaller than a large cap, and then the small cap are your small stocks,
yep.
Right? And the significance of that is that in any one given period of time, small cap stocks can outperform large cap stocks and vice versa. So one thing that we like to say in our practice is the diversification is important. So it's nice to have a portfolio that's including all of the above.
Yep. And a lot of times, newer companies may start out as small cap, and they don't necessarily pay a dividend, where you have some of these large cap.
Yeah, if it's a value-driven stock, they might pay a dividend. And so let's talk about the significance of a dividend. So what's a dividend? Well, you own the stock. And you own shares of the stock. So what the board of directors of this company decides to pay a dividend. In other words, they're going to pay you so much per share. So let's say you have a share of stock, and let's say that the stock's worth $100, and they decide they're going to pay you a dividend of $4 a year. So that's a 4% dividend that you're getting. So typically what they'll do is they'll declare a dividend every quarter. So the board of directors will meet and they'll look at earnings and they'll look at cash flow and they'll determine whether a dividend is something that the company can afford to pay. And if they can afford to pay it, they'll pay, so if they're going to pay you $4 a share, they'll pay you $1 every quarter. So they'll declare that, and then you get paid a dividend.
Well, good. So let's move on to the bond area.
Yeah, so a bond is a different type of investment from a stock in that now this is considered a debt security. So, and there's different types of bonds, but if you're looking at a corporate bond, a company might issue bonds because they've got maybe they have a special project or a special maybe they're doing some additional building or they're growing in a certain area and they want to issue bonds or debt as opposed to stock. So when they issue bonds, they're going to pay the bondholder interest, or what they call a coupon rate, interest rate. So if let's say that I'm working for a company that is going to issue bonds, okay, and you're an investor, and you want to invest in my bond, the bond of my company. So you're gonna buy this bond, and in exchange for you buying the bond, my company is going to pay you interest on that bond. So the interest is going to be based on what the market conditions are. So if I have good credit and I'm a good credit risk, the interest rate's going to be lower than if I have bad credit. Because if I have bad credit, that's more of a risk that you're taking, because now you're buying this bond, but you're not so sure you're going to get your money back because I don't have as good credit. Yeah. So that determines what the interest rate is. Now the significance of the bond, Steve, as we're relating it to the stock, is that the bondholder is standing in line in front of the stockholder as far as liquidation is concerned for the company. Mm-hmm. So the company has to pay the bondholder before they pay the stockholder. Mm-hmm. So the stockholder is taking more risk than the bondholder.
And hopefully for more return.
And for more return.
Yes.
Well, that's true. So they're taking more risk, and in exchange for the risk, they're getting a higher reward.
Yes.
That's the goal.
Yep. So let's move on to mutual funds.
Yeah. By the way, we covered the stocks and the bonds pretty extensively in our last show. So again, if you're interested in getting more information on those topics, you can go back and view our last show, or you can always contact our office.
Yes.
We'd be happy to sit down and go over all this stuff with you. We'd love to do that. Mutual funds. So why would an investor buy a mutual fund? What is a mutual fund? So a mutual fund it's actually a diversified investment, right? So you can get diversification within one mutual fund for a very small amount of money, right? So a mutual fund is a composite of many different investments. So it could be stocks or bonds or a combination of stocks and bonds, right? So what the mutual fund company is doing is they're going out and buying hundreds and hundreds of different stocks, and they're holding them in the portfolio. And as a mutual fund investor, you're buying shares of the mutual fund. So now when you buy shares of the mutual fund, you're actually owning a small piece of every company in that mutual fund portfolio. So you could, for a small investment, let's say $500, $1,000, you're buying shares of a mutual fund, and you could own a little piece of literally, 500 different stocks if that's what's being held in the portfolio. And the other thing that's popular with mutual funds are index mutual funds. So let's say you have an index mutual fund that mimics, let's say, the S&P 500 index. Okay, so now you own the index fund, but in reality, you're owning a little piece of every stock that's in the S&P 500. So it's a good way to get exposure to the market for a relatively small amount of money. It's very efficient, right? Because how else would you do that, Steve? If you had a brokerage account, you'd have to go out and buy
500.
You'd have to buy stocks in 500 different companies, which isn't very practical to do that, right? So that's what has made mutual funds so popular over the years, is that you can get instant diversification. And earlier we talked about bonds, we talked about stocks. So you can buy a bond mutual fund, you can buy a stock mutual fund, and then you have the funds that mix the stocks and the bonds together. That's a balanced mutual fund. And you can get diversification, not only with company diversification, you can get diversification among investment lines with one mutual fund.
Yep. And I'm not sure if we touched on target funds, and I know they've become popular.
Yeah, they've become popular.
Yeah.
So what a target fund is, it's an attempt at getting diversification and also adjusting the risk in the mutual fund portfolio as you get older and as you move closer to retirement. So an example of that would be, let's say that we have an investor who is going to retire in the year 2050. Okay, so 25 years from now. So you can buy a target 2050 fund. And in the 2050 target fund, they're going to have a portfolio that's made up of stocks and bonds. Okay, now since that's 25 years away, it's going to be primarily stocks. Okay, there's going to be some bonds in that portfolio, but it's going to be primarily a stock portfolio. Now, as you move closer to that target date, the portfolio automatically adjusts and becomes more conservative, meaning that the portfolio has a higher portion of bonds and a smaller portion of stocks as we move closer to the target date. Okay, now, what's the problem with that? The problem with the target funds are that it's strictly buy and hold. Okay, there's no way for those target funds to react to what's going on in the market. So a prime example of where that could get you into some trouble is what happened in 2022, when we had a down year, let's say, in the bond market. And that bond downturn, if you will, was due to the fact that interest rates were increased by the Fed several times. So each time the Fed increased interest rates, and this was all done to and control inflation. But every time the Fed increased the interest rates, the bond prices went down. So if you were holding one of these target funds, let's say you were holding a target 2025, okay? This is 3 years ago. This is in 2022. So you're holding a 2025 fund, meaning that you're only 3 years away. So that portfolio is made up predominantly of bonds. We're getting close to the target date. Well, the bond market had a double-digit decline, right? You remember this,
Down
right?
as much as stocks.
Yeah.
Yep.
But the problem is that these target funds couldn't react. So they were down significantly. And to further accelerate the problem is there's no coming back from that. In other words, the bond market didn't recover as quickly as stocks were down that year also, but the stock market recovered quicker than what the bond market did. So you have to be a little careful when you're investing in target funds because it is strictly what we call a buy and hold strategy, and that strategy can get you into trouble in certain markets.
And that's like an index fund. There's no navigation. There's no professional money manager. So
Yeah, well,
in an
that's
up market, it's great.
You're right. Well, that's right. So conceptually, it's the same thing. So it's buy and it's hold. So if you have an index fund, right? So the example that we gave earlier was the S&P 500, right? So you're in the S&P 500 index fund. Now the index fund, it's great when over time the funds have done well, but if you have a period of time where there's a lot of volatility or the market's going down or it's reacting to something that's going on in the marketplace, these index funds don't react to that. They simply are holding the underlying index, the underlying funds.
Yep. So when we move on, I know when I first got in this industry 30 years ago, we didn't know really about ETFs at that point, and they've come a long way.
Yeah, the ETFs, ETF stands for Exchange Traded Fund. So the significance of an ETF, so an ETF acts, in a lot of ways it acts like a stock, but in other ways it acts like a mutual fund, right? So an ETF, it could be just like we described with a mutual fund. It could mimic an index. It could buy certain stocks based on certain criteria.
Precious metals or
Yeah,
gold.
you could buy a gold or a silver ETF. A bond ETF. It's almost as diverse. It's almost a diverse asset class as the mutual funds are. The difference is how often are mutual funds priced once a day. An ETF is dynamic pricing, meaning that as long as the market is open, there's a current price.
And something you said key there, I'm not sure a lot of people realize that a mutual fund, when you put in that trade, not that doesn't matter, but it doesn't get you real time.
No, if you so let's say the stock market is open right now, and you want to buy into this mutual fund. The price that you're going to get is the price that it's valued at the end of the business today. You're always going to get the closing price. So the market closes at 4 p.m. Eastern Time. Yep. So that's whatever the price is when the market closes at 4 o'clock. That's what you're going to get when you either buy or sell. Okay. So if you put a sell order in, so you can put a sell order in very early in the day. Let's say when the market opens at 9:30, you put a sell order in. You don't know what price you're getting until the end of the day when the market closes at 4 o'clock. An ETF doesn't work that way. An ETF has dynamic pricing. So if it's 10 o'clock in the morning and you're buying an ETF, you're going to get whatever it sells for at that moment in time. When that buy order hits the trading floor or in this case the internet, it's because this is all done electronically. That's the price you're going to get. Buying and selling, it's dynamic pricing. So the ETFs become very popular in that regard because again, you can get diversification, and also not only are you getting diversification, it's very inexpensive, right? Like so you can get there's ETFs that you can own that are like really inexpensive. Like we're talking 10 basis points or less to own an ETF. So it's become a very efficient way to get diversification and also to get dynamic pricing.
Yep. So when we move on to the next one, separately managed accounts, SMAs, we might put IUTs in there, investment
Unit investment trust.
Unit investment trust.
Yeah.
Let's get into those a little bit.
Well, these are all ways to get like actively managed accounts that are diversified, right? You're getting diversification. So whether it's in a unit investment trust or a separately managed account, these are all different packaged investments that are ways for you to get diversification. What's available to the consumer right now is quite fascinating because you can get just about anything you want for not a lot of money, right? It used to be, investing was for the wealthy, right? So you had to have a lot of money. You had to, open up these investment accounts, these brokerage accounts. Now, the walls have come down, and it's really, which is a good thing because now everybody can do it. Everybody should be doing it, especially if, and I want to drive this point home, if you're working and your employer has a company-sponsored retirement plan, like a 401k, you have to invest in it. It's just so smart to do that because you're going to buy, most likely you're going to be buying mutual funds inside the 401k. So we talked about the different kinds of mutual funds that you can own. And what else are you getting, Steve? You're getting tax-deferred growth, right? So you can either do it in a traditional sense or in many cases you can do it with a Roth, okay, inside this 401k, which means you're getting tax-free growth. Oftentimes the company will match, right? So there might be a 100% match or there might be a 50% match, but regardless, that's free money to you.
Yep.
And that's really how we're building wealth with this. The next generation of wealth in this country, for the most part, has been built on the 401k.
Yep.
It's made millionaires out of a lot of people.
Yes.
Right? Just because of the
Yep.
fundamentals of years and years and years of tax deferral and dollar cost averaging into the market, which means every paycheck you're buying into that mutual fund regardless of what the price is.
Yep.
So 401k, if your company has it, you have to do it.
Yep. Now moving into a little different class, annuities.
Yeah. Well, annuities are
and I know we've done
we've
shows
done
on just annuities.
Yeah, we've done shows just on annuities because we feel really strongly about it, number one. And number two, they're so complicated and there's so many different kinds of annuities that, you can't really cover it in the 3 minutes that we have here today. But annuities are really a very powerful investment vehicle that you can use to accomplish a variety of different objectives, whether it's income, whether it's a death benefit, whether you want to try to protect your investment in some sort of way, principal protection. But the annuities are offered by insurance companies. And the important thing to remember, and annuities get a lot of bad press and a lot of bad publicity, and I think a lot of that is because they're misunderstood and really misused, I think, in a lot of cases. But they're also a very effective part of the planning process, which we've done, and we've used annuities as part of the planning that we do.
And it's the only time we can use the word guarantee. So for people that say, I want to be guaranteed.
Yeah, so there could be a guarantee. The
Yeah.
income benefit could be guaranteed. The death benefit could be guaranteed. But there's some guarantees on there that are really important. But again, it's you want to make sure they're being used properly and have the proper diversification. So I think we're heading towards the end here, Steve. Boy, it's hard to believe. It's hard to cover all this stuff in the brief time we have here on PCTV. But if you want more information, we'll put the contact information up on the screen. If you want a free consultation with somebody on our team, we can sit down and go over anything that we've covered today. But this is a great topic, Steve. Good job putting this program together for us today. And with all that being said, we're going to sign off. This is Financially Speaking.